The mainstream crypto analyst community has been getting XRP wrong. Not wrong about whether it has value, but wrong about the mechanism that determines how much value it has. And more critically, when that value gets priced into the market. That distinction matters more than you think. Because getting the mechanism wrong is what produces a $5 to $8 price target. Getting the mechanism right is what produces a fundamentally different number. One grounded, not in chart patterns or bull market multiples, but in the economic mathematics of disrupting a market that generates over $2 trillion in annual fees. Patrick Bet-David understood the mechanism. Tonight, we're going to prove it. I'm your host. Welcome back to Token Frontline. Tonight, we are building the complete picture. What Patrick's analytical framework actually says, why it is categorically different from the technical analysis approach dominating crypto YouTube, the 3 specific errors the mainstream analyst community made when they pushed back on it, and what the utility pricing model actually produces when you run the real numbers. Every data point in this video comes from publicly available institutional research, regulatory filings, World Bank remittance databases, and Ripple's documented commercial deployment. This is not financial advice. Nothing here is a recommendation to buy, sell, or hold any asset. This is educational analysis for informational purposes only. Always do your own research and consult a qualified financial professional before making any investment decisions. Now let's build this. Start with the foundation, because the credibility of any price prediction framework depends entirely on what it's built on. Patrick Bet-David did not build valuetainment into one of the most watched financial media platforms in the world by chasing chart patterns. He built it by applying a consistent, repeatable discipline rooted in business fundamentals. 4 questions every time. How big is the market being disrupted? How strong is the team and technology doing the disrupting? What does the regulatory environment do to the adoption timeline? And where is the institutional money moving before retail observers can see it? That is not a crypto framework. That is the framework of a serious business analyst, applied to a domain that most business analysts have not studied carefully enough to apply correctly. So when Patrick looks at XRP, he's not looking at a cryptocurrency whose price moves on sentiment cycles. He's looking at a technology product, Ripple's on-demand liquidity, or ODL, that uses XRP as the functional bridge asset for cross-border settlement. And he's asking the only question that matters for a disruptive infrastructure product. What is the addressable market? What is the realistic penetration rate? And what does the bridge asset need to be worth to support the settlement volume that penetration rate implies? That question is not answered by looking at XRP's all-time high and applying a bull market multiple. It is answered by understanding the mathematical relationship between settlement volume and bridge asset price. And that is a calculation most retail analysts have never run, and that most crypto content never discusses. Drop utility math in the comments if you've actually seen that calculation done correctly before. Because in my experience, the number of channels running settlement volume to price calculations instead of ATH multiples is very, very small. Here is the market being disrupted, stated precisely, because precision is what separates analysis from hype. The global cross-border payment market processes approximately $150 trillion in transaction volume annually. The correspondent banking system that settles most of that volume charges an average of 1.3 to 1.5% in combined fees across the full settlement chain. Correspondent bank markups, Nostro account opportunity costs, FX conversion spreads, and processing delays. For the retail remittance segment, the World Bank's remittance price database puts that figure at 6.3%, over 6 cents on every dollar cent. Total fee extraction from the correspondent banking system, approximately $2 trillion per year. That is the market being disrupted. Not disrupted theoretically, disrupted operationally, right now, in live payment corridors across Asia Pacific, Latin America, Europe, and Sub-Saharan Africa. Ripple's ODL product, when deployed in a corridor, eliminates the pre-funded Nostro account requirement. It compresses FX conversion to real-time XRP bridge settlement. The corridors where ODL is most active, Japan, Philippines, Australia, Singapore, Mexico, Brazil, show measurably lower fee costs than the global average. This is documented in World Bank data. This is in Ripple's corridor-by-corridor reporting. This is not a white paper promise. It is an operational reality with a documented track record. And now here is where Patrick's framework diverges from everything else you will see on this topic. If Ripple's ODL captures just 5% of the cross-border settlement market, that is $7.5 trillion in annual settlement volume, the question becomes, what does the XRP price need to be to provide the liquidity that volume requires? That is the utility pricing calculation, and it produces numbers that chart-based analysis never reaches. When analysts pushed back on Patrick's framework, they made 3 specific identifiable errors. Let's name them clearly, because understanding where the competing framework breaks down is just as important as understanding where the correct one holds up. The first error is using market cap comparison as the primary valuation tool. The argument goes like this. For XRP to reach Patrick's implied price target, the market cap would have to exceed Bitcoin's. And since Bitcoin has first mover advantage and deeper institutional adoption, that's implausible. Therefore, the target is wrong. The logical error here is fundamental. It treats XRP and Bitcoin as competing for the same market cap pool when they serve completely different functions. Bitcoin is a store of value. Its market cap is determined by how much of the world's wealth wants to be stored in a scarce digital asset. XRP is a payment settlement infrastructure asset. Its market cap is determined by the settlement volume flowing through it and the liquidity reserve required to support that volume. Using Bitcoin's market cap as the ceiling for XRP's market cap is the same logical error as using gold's market cap as the ceiling for Visa's total transaction value. 2 different functions, 2 different valuation frameworks. The comparison is not just imprecise, it is structurally invalid. The second error is ignoring the velocity of money relationship between XRP's price and settlement volume. Most analysts model XRP's price as a simple supply and demand equation. More buyers, higher price. Patrick's framework recognizes something more sophisticated. XRP has a functional price floor, a minimum price determined by settlement volume requirements and liquidity pool depth. At current ODL volumes, that functional floor sits below the speculative trading price, meaning sentiment is still the primary driver. But here is what the chart analysts miss entirely. As ODL deployment scales, the functional floor rises. And when that functional floor crosses the speculative trading price, the adjustment is not a gradual move. It is a step change. The chart gives you no warning. The utility model does. The third error is modeling institutional adoption as purely demand side. And this is perhaps the most consequential error. And almost nobody in retail analysis talks about it. Most analysts model institutional ETF buying as adding demand to a fixed supply, standard demand and supply curve. Higher demand, higher price. What they fail to model is the supply side of institutional adoption. As XRP moves into institutional custody vehicles and ODL operational reserves, It leaves the speculative trading float permanently. Institutions don't day trade their settlement reserves. That XRP is gone from the liquid market. The speculative float shrinks as adoption scales. Rising demand, meeting a shrinking float, produces a materially different price trajectory than the demand-only model. And the chart captures none of it until the move has already happened. Now let's look at the documented evidence, because this isn't theoretical. The institutional fingerprints are already visible in the public record. Goldman Sachs disclosed a significant 13F position in XRP ETF vehicles, the largest institutional filing from any Wall Street firm in this space. Standard Chartered, whose emerging markets research division applies rigorous quantitative methodology and not chart analysis, has published XRP price targets of $5.50 near term and $12.50 on regulatory catalysts. Bank of America holds over 100 Ripple-related patents built across more than a decade of development. These institutions are not retail speculators. They are operating on the same business fundamentals discipline that Patrick articulated. They are asking the same questions about addressable market size, penetration rate, and utility pricing. And their answers are documented in SEC filings, research reports, and patent databases that anyone can access. The World Bank Remittance Price Database corroborates the ODL case corridor by corridor. The corridors with active ODL deployment show systematically lower fee costs. The disruption is operational, measurable, and confirmed by the most credible international financial data source available. Now let's run the numbers, because this is where the framework either holds or breaks. The ODL bridge asset pricing model works through 3 steps: settlement volume requirements, liquidity pool sizing, and minimum token price. With XRP's current circulating supply, accounting for escrow releases and institutional lockups reducing the liquid float, the outputs are as follows. At 1% penetration of global cross-border settlement volume, the functional price floor lands in the single-digit dollar range. At 5% penetration, the functional floor moves into the range Standard Chartered's research targets. At 10% penetration, it enters the range Patrick's framework implies. These are not arbitrary numbers. They are outputs of a settlement volume calculation run against a liquidity pool sizing model. And the historical precedent holds up. Visa and SWIFT both took 10 to 15 years to reach 10% penetration of their respective target markets. ODL is currently 5 to 7 years into its commercial scale deployment. The trajectory is consistent with every major payment infrastructure adoption curve in modern financial history. The asymmetry here is the key takeaway. At current prices, the structural floor represents minimal downside compared to the upside targets that emerge from the utility model. The risk-reward is not produced by hype. It is produced by applying the right valuation framework to the right type of asset. The chart-based analyst watches price. The utility model analyst watches catalysts, because the catalysts are what move the functional floor before the price reflects it. 3 triggers are running simultaneously right now. First, ODL corridor deployment milestones. Every time Ripple activates a major new payment corridor, the required liquidity pool size increases and the functional price floor rises. Watch the corridor announcements, not the candlesticks. Second, the passage of the Clarity Act. Statutory regulatory certainty is the single biggest unlock for institutional allocation committees. These are not traders. They are procurement functions operating under fiduciary mandates. They cannot move from evaluation to execution without legal clarity. The Clarity Act moves the legal risk from possible to resolved And when that happens, institutional allocation committees don't deliberate, they execute. Third, the institutional commitment wave. Watch the ETF flow data. When the institutional allocation ratio in XRP ETF vehicles shifts toward the ratios seen in Bitcoin's ETF maturation, the demand driver becomes structural. And remember error number 3. Every dollar of institutional allocation that moves into custody or ODL reserves shrinks the speculative float. The two forces compound each other. These 3 catalysts will not show up on a chart until after the move. The utility model identifies them before. The conventional analyst community looked at the chart, applied a multiple, and called Patrick's framework unrealistic. The business fundamentals analyst looks at the settlement volume, models the functional price floor, accounts for the shrinking speculative float, and produces the targets that serious institutional research teams are already working toward. Being wrong about the framework doesn't just mean being wrong about the price. It means being wrong about the timing, which often means exiting a position right before the step change the utility model predicted. So here is my question for the comments. Are you using a chart-based model or a utility pricing model for your XRP target? And what ODL penetration rate of the global cross-border settlement market do you think is realistic over the next 3 years? Hit the like button if this gave you the complete analytical picture, and subscribe with the bell on. Because when ODL deployment data, the Clarity Act timeline, and institutional flow data cross significant thresholds, the breakdown drops here immediately. I'll see you in the next one.